Okay, so we were here last Thursday. Okay, so basically we were talking about the generic formula to calculate the break-even points in units and in dollars are total fixed cost plus operating income. That's on the numerator, divided by the denominator. That is the contribution margin per unit if you are calculating the units, or it's a contribution margin ratio if you are calculating the dollar amount. Okay, so that's the generic formula. And I remember Megan was talking about the tax rate. Okay, so the tax rate is here. Okay, so where does this come from? So your operating income is not the same as your net income. Okay, so your operating income, and then you need to pay tax on the operating income, okay, to CRA. So whatever left, that is your net income. So basically, your net income equals the operating income after you pay the tax. So that equals operating income times 1 minus tax rate. Okay, so that's your net income. So then if you solve your operating income equals net income divided by 1 minus your tax rate. And then you just replace the operating income in this formula. Okay, this formula, you just need to replace the OI, operating income, with this net income equation here. So then you get these two new formulas with net income and a tax rate. Okay, so make sure you are clear that these formulas are talking about the operating income that is before tax. So if you know the net income, you know the tax rate, you can use this to work backward to figure out what's the operating income. Okay, so do we have any question on this? So if you were given in the question, if you were given the net income, okay, so that's the formula you are using, right? If you are given the operating income, this is the formula you are using. Are we clear?
Yeah.
Okay, good. Okay, so move on, and we did this one. The answer is this. Yeah, we did this one. Okay. So now let's talk about a new concept, margin of safety. So what do we mean by margin of safety? Okay. So you are familiar with this graph. So this point here, okay, so that's the break-even point. Okay. And the dollar amount is $44,000. Okay. And then suppose that right now our sales is at 88,000. Sorry, here's the 48,000. The break-even sales. Okay. And now suppose the actual sales right now is 88,000. Okay. So there is a difference. Okay. So you use the 88, that's your actual sales, minus the break-even sales, 48,000. So the difference is 40,000. So this 40,000 is called the margin of safety. What does this mean is even your sales is reduced by this number, 40,000, you are still achieve break-even. Okay. Any amount more than this, you will be at a loss. Okay. So this tells me how much sales I can afford to lose, right, before the break-even sales, right? Okay, so this is the safety, the margin of the safety. Okay. So the next concept is called the margin.
One quick question.
Yeah.
Sorry.
Go ahead.
The margin of safety isn't taking into account tax, though. Like those are completely separate processes.
The margin of safety in dollars is the sales, the difference between the actual sales and the break-even sales.
Okay.
Yeah.
Cool. Thank you.
Yeah. Okay, and then we're going to introduce this one, the margin of safety ratio. Okay, so basically it's whenever we say a ratio, it's a division, right? That's a ratio. So margin of safety ratio equals margin of safety in dollars divided by the actual or expected sales. So in that example, the margin of safety, the difference is 40,000 and the actual sales is 88,000. So then I get this 45.45%. That's for the margin of safety ratio. Okay. So that's the two different concepts. Okay, so what does this mean? Okay, this means the company sales can fall by 45.5%, okay, before it generates the loss situation, okay? So the higher this number is, okay, the greater the safe margin is, okay? The higher of the percentage of the dollar value, the greater the margin of safety is, the better it is, right? You wish to have a larger number, right? You wish to have a larger number, okay? Does this make sense? Okay. Okay, here's the question. The margin of safety refers to, let's take a look, who is, okay, James. James?
Sorry, it's B.
B, the amount by which sales exceed break-even sales. Thomas?
It should be B. I think.
Okay. Karen?
B.
Okay. So you are right. The answer is B. Okay, the answer is B. Okay, good job. So now let's talk about the data analytic. Okay, data analytic is one of the biggest topics nowadays with the CPA. Okay, when I was a student, there's no emphasis on the data analytic. Okay, so it makes sense. Right now, there's a lot of data generated every day, right? So the raw data sometimes is not as useful, right, as you want it to be. Okay, so the whole idea is you wish to be able to have the skills to analyze this data, okay, to generate some graphs, right, tables, whatever, make it more visual, right, for people to make a decision, right, easier for people to make a decision. So that's why this data analytics is important, and the CPA competition map put a lot of emphasis on this nowadays. Okay, so as a future CPA, you have to be knowing all these data analytic things. So Excel is one of the tools, right? It's one of the many tools, right? So you are able to use Excel to generate graphs, right? To do different things. Okay. So basically, what is data analytic? It's the science of analyzing raw data to be able to draw conclusions about that data. Okay. So some of the examples would be the casino. Okay. So casino would use data analytic. They want to track, okay, what are the activities that generate the most revenues and operating income. Okay, so they want to know which game maybe, okay, or which activity help them to make more money, right? And then for the decision maker would be, okay, I'm going to encourage more, right? I'm going to encourage more on this. When I was a student in Waterloo, there was one of my favorite restaurants. It's called a Mandarin. Okay, it's only in Ontario. Okay, so it's a very nice restaurant. Okay, so what's interesting about it is in that restaurant, they only make $1 for each visit, each person every time, right? So they really go by volume. But they notice that the most profitable items is the drink, okay, the juice, whatever. So then the company will, right, the restaurant will just encourage their employees, the waiters, waitress, to try to sell those items, okay? So that's one example. And then DHL, okay, they want to know, okay, so they use this data analytic. So they've determined the best size of aircraft to use for shipment, okay? So they want to know, okay, what's the perfect size, okay, of the aircraft for them to use, right? The bigger, okay, it costs more, right? Right, it can take more things, right? But it costs more. But they may don't have that many items, right? And so then they were able to use the data they have to figure out what it would be the optimized size. And so this is a concert, right? This is concert event promoter, okay? They would use data analytics to perform some break-even analysis. What's the minimum amount of audience I need to not lose money, right? So, you know, safety margin, right? If I'm making, you know, if I'm selling at this price, right? I'm making this sales, what is my safety margin, right? So this is all the examples. This cost volume profit analysis, okay, it's very useful tool, okay? Especially nowadays, the business environment is constantly changing, okay? So let's take a look at this example. Suppose the selling price is 400, variable cost is 200, total cost is 180. Can anyone tell me what's the break-even sales here? For real quick, right? You can just do it like instant, like this. 5, 4, 3, 2, 1. Okay, go. What's your answer?
I think I did it wrong, but I think I got 900. And I think it's
900?
wrong.
Okay.
Yeah.
900, is that right? Okay, Karen. Okay, Dan Pearson,
Yeah, I agree with 900.
900. How did you get 900? Okay, anyone else?
I think I got 360,000.
Okay, it's 360.
Nope. I don't think that's right.
And Rachel?
The answer I got was that you needed to sell 900 units in order to cover your fixed cost.
Oh, you sell 900 units, okay?
Yeah.
Okay, I see. So that's correct. So then all the answers are correct. So you need to sell 900 units. All the sales dollar is 360,000. Okay, good job. Okay, so what you do is using these two numbers, you know that the contribution margin ratio is 50%. So 180 divided by 50%, that's the 360. Okay. Okay, now there are some changes, proposals, okay? If they add a new piece of equipment, okay, the unit variable cost will be $20 lower from 200 to 180. The fixed cost, the fixed cost, right, because you have a new piece of equipment, the fixed cost will increase by $60 from 180 to 240. And then this will make a better product, okay? So then you can sell it for more money. So the selling price increased by 50 from 400 to 450. And now, what is the break-even point? Does anyone know? Rachel?
I got that you need to sell 889 units in order to
Okay.
cover the fixed cost.
Okay, Aaron?
I got the same thing as hers. It's 889 units.
Okay, Kate,
400,000
okay,
dollars.
400,000. Tammy,
It's 889 units as well that I got.
okay, Xudong,
889 units.
okay, Jimmy, Mario,
Yeah, I got 889 units as well.
okay, yeah, so that's correct. So again, you calculate the margin of the contribution margin per unit, right? Using the new numbers. So 450 minus 180, so that's 270. And the new fixed cost is 240. 240 divided by 270, so that's the 889 units, okay? Okay, so now let's talk about sales mix. So companies sometimes sell something in package, right? So the classic one would be the Tylers, right? Maybe Shaw, right? They try to sell you a bundle, right? Maybe a home phone, cable, and internet service all together as a package, right? So that's called a sales mix, right? Sales mix. So you are offering multiple products, right? And then in one transaction. Okay, so here in our analysis, the assumption is that the mix is constant. So okay, so the percentage of the percentage of each product is the same, remains the same. Okay. The decision is what mix of products to sell. Okay, so the relevant percentage in which each product is sold when more than one product is sold. Okay, so you want to figure out what mix of products to sell. Okay, so let's take a look at this example. Okay, so here you have two types of products, smartphone and TV. And for each product, you know selling price, variable cost, contribution margin, okay? And you know the total fixed cost, 275,000. And the sales mix will be 75% of the smartphones and 25% of the TV, okay? That's the sales mix. So for every 3 smartphones, you have 1 TV, right? Every 3 smartphones, you have 1 TV. So the first step is to calculate the weighted average unit contribution. So you are able to calculate the contribution for each product, right? This is easy. We have learned how to do this, okay? But for this sales mix, we need to calculate the weighted average contribution margin. So how you do that? You just pick the unit contribution margin for the smartphone and times the percentage of the sales mix, okay? And then you do the same thing for TV, okay? And then you add them together. Okay, so 200, that's the contribution margin per unit for the smartphone. And the smartphone, in terms of percentage of the sales mix, is 75%, 200 times 0.75, plus 500 times 0.25. So your weighted average unit contribution margin is 275. The second step, you find the break-even point in units. Okay, so total fixed cost is 275,000 divided by weighted average units contribution margin 275. So your break-even point in units is 1,000 units. Okay, this is a sales mix, right? This is 1,000 units, including smartphones and TVs, right? Step 3, you figured out the number of units for each individual product. Okay, so in total, there's 1,000 units, but 75% of that is smartphones. So 1,000 times 75%, so you have 750 smartphones. And for TVs, 1,000 times 25%, that's the sales mix. So you have 250 TVs. Together, 750 plus 250, together, that's your 1,000 units, okay? So we are saying that when you sell 750 smartphones and 250 TVs, this is your break-even point. You covered the total fixed cost, right? Is that right? Let's check it, right? So we know the break-even point is when the total contribution margin equals fixed cost, 275,000. So let's take a look at the total contribution margin. So for the smartphone, you have 750 units, and each one gives you $200 contribution margin. So that's the contribution margin of the smartphone. And you add the contribution margin of the TV. Okay, so 250 units times $500 per unit. So when you do this calculation, you get 275,000. So your total contribution is 275,000, which equals to the total fixed cost. So that's your break-even point. Okay. Does this make sense? Yeah, it's not that challenging, right? It's pretty straightforward. Okay, so my question here is, which one do you wish to sell more? Do you wish to sell more smartphones, or you want to sell more TVs?
Smartphones.
Smartphones. Why? Isabella?
I had it and then I lost it. I think you have to, I think you want to sell more smartphones
Okay.
because of the sale mix.
Okay, and Ruben?
I was thinking TVs, but I could be wrong just because they make you more money, it looks like.
Okay, that's correct. So if you see the contribution margin, so the smartphone only make you $200, right? And the TV will make you $500. Okay, so if you can only sell, if you want to sell more items, TV will help you to make more money. Okay, so the idea is operating income will be greater if more high contribution margin units are sold than the low contribution margin units. Okay, so when you sell the high contribution items, your operating income will be higher. Okay, so we have learned how to calculate the break even in units. So let's take a look at how to do the calculation for the break even in sales dollars. Okay, in sales dollars. So here, okay, we have two divisions. Okay, the indoor plant division, the sales variable cost contribution. It even tells you the percentage of sales. Okay, so the contribution margin is 40% for the indoor plant division. And for the outdoor plant division, you can see all these numbers, and the contribution margin ratio is 30%. And then this number is the total, okay? The total. Okay, so what's the sales mix? Sale mix percentage. How did you calculate this? Sale mix. Well, the indoor plant division, 200,000 sales, and outdoor plant division, 800,000 sales. Together, the company total sales is 1 million. So the sales mix for the indoor plant division would be 200,000 divided by the total 1 million. So that's the 20%. And for the outdoor plant division, that sales mix is 80%. Okay. And in this question, the total fixed cost is 300,000. That's given. So how do we calculate the, if you remember, how do we calculate break even in sales, in dollars of sales? What's the magic formula to calculate break even in dollars of sales? Hussein?
So my hand is raised from the previous
Okay,
question.
legacy. Yeah. Jimmy?
I got total fixed cost divided by the per unit sale price.
Yeah, so per unit sale price. That's not true. Okay. Rachel?
Fixed cost divided by weighted average contribution margin ratio.
That's good.
That should-
Yeah. Yeah, that's good. Remember, when we figured out the sales, we use the total fixed cost divided by contribution margin ratio, right? So in this case, it's the sales mix. So we have to figure out what's the weighted average contribution margin ratio. And you can see here, right? For the, if you see the total company, it's a 32% contribution margin ratio. So what do? For the indoor, the contribution margin ratio is 40%, and the sales mix is 20%. For the outdoor, the contribution margin ratio is 30%, the sales mix is 80%. So you figured out the weighted average contribution margin ratio is 32%. Step 2, you use the formula Rachel just said. Total fixed cost 300,000 divided by the weighted average contribution margin ratio, and you get the break-even point in dollars, 937,500. Step 3. What is the sales dollars per product? Well, the total sales is 937,500, and 20% of that sales belongs to indoor division. So the multiplication gives us 187,500, and the remaining 750,000 goes to the outdoor plant division. Okay, so is this correct? So let's double check, right? So the sales for the indoor 187,500 times the contribution margin ratio, and this gives me the total contribution from the indoor division. And the 750,000 times 30%, this gives me the total contribution from the outdoor division. So together, these two numbers in the bracket, that's my total contribution, okay? And minus the total fixed cost. So I get 0, okay? So my total contribution equals the total fixed cost, okay? So are we clear with this sales mix? So the formula is still the same, right? You are still using contribution margin per unit, but the difference is this time it has to be the weighted average, right? If you figured out the break-even point in units, instead of using the contribution margin per unit, you are using the weighted average contribution margin per unit. And normally when you calculate for one product, the break-even point in dollars of sales, you use fixed cost divided by contribution margin ratio of that product, right? But now you have more than one product. You have to use the weighted average contribution margin ratio. That's it, right? So any questions on this? Okay, so I will move on. Let's take a look at this question. So what's your answer? Okay, so Kate Chan.
I think it's B.
B, okay. Nima,
Yeah, I was gonna go with B.
Kate,
I would say B as well.
Long,
I think it's B too. Yeah.
okay. Yeah, that's correct, right? That's correct. So you just consider that there's 1 unit, right? There's 1 unit, but 75% of that is the smartphones, and 25% of that is the TV, right? So per average unit, okay? Cost structure. So cost structure are the relative proportion of the fixed versus variable cost, okay? And this cost structure, okay, so do you have more fixed cost versus variable cost, or you have more variable cost, right, versus the fixed cost? So that's the cost structure, right? So it has impact on contribution margin ratio, break-even point, and margin of safety ratio, okay? So I'm going to show you one example. Okay, so in this example, you have 2 companies, ABC Ltd and DEF Ltd. Okay, so what's interesting about this is the sales are the same, 800,000, and the operating income is the same, 120,000. Okay, so the total cost is the same, 680,000. Okay, so the 2 companies, they have the same sales, they have the same total cost, and they have the same operating income. But what's difference between these 2 companies are the relative portion of the fixed cost versus the variable cost. So for ABC, the variable cost is 480, and the fixed cost is 200. So variable fixed, okay? There are 480 variable, 200 fixed. In total, that's 680. For DEF, they have 160 variable, but 520 fixed. So for DEF, they have more fixed cost, okay? For ABC, they have more variable cost, but the total cost is the same, okay? So let's see how these 2 different structure, ABC is heavy with variable cost, DEF is heavy with fixed cost. How does this affect contribution margin, break-even point, and the margin of safety? So why don't you do the calculation? So you calculate contribution margin for ABC and the DEF, and you calculate break-even point for ABC and DEF, calculate margin of safety for ABC and DEF. Okay, so do it